Hi, this is Trevor, and today we're going to talk about the 1031 exchange process. The 1031 exchange, formerly known as the Starker exchange, is a tax deferral strategy that allows an investor to relinquish a business or an investment asset and acquire another asset without having to pay capital gains taxes, or effectively deferring the capital gains taxes. It's a little bit of a complicated process, but it makes a lot of sense, and the 1031 exchange is actually one of the most beneficial advantages to a real estate investor in terms of tax benefits, and it allows the investor to keep their capital invested throughout the lifetime of their investment career without having to take portions of it and pay capital gains taxes with it. Let's go over how it works. So in a typical buy-sell process of real estate, let's say this is our investor, this is the taxpayer who is taking advantage of the 1031 exchange. In a typical buy-sell transaction, the investor would receive cash from the buyer in exchange for the deed in the sale. At that point, a portion of that money would need to go to the IRS in the form of capital gains taxes, assuming that the seller or the investor made a profit and had some appreciation in the transaction. Take a look at the numbers behind that. If you had, say, a $1 million gain and we're paying a 35% tax rate on capital gains between state and federal, then the taxpayer would be liable for approximately $350,000 to the IRS. Well, moving forward, that $350,000 could be translated into another $1.4 million in purchase price if that investor was leveraging at 75%. So they could buy $1.4 million less real estate because of the capital gains liability. The 1031 exchange came about because an investor named Starker wanted to trade lands for other real estate and felt like because there wasn't a capital gain that was realized, he shouldn't be liable for the taxes. And so originally, and still to this day, a one-for-one deed swap between two real estate owners qualifies and does not trigger any sort of capital gains liability. But through the process of that, it became apparent that it's very difficult to find a buyer and a seller, or two sellers who want to exchange properties from each other, especially at the same time. It's extremely rare. So normally what happens these days is what's called a delayed exchange. And the delayed exchange gives the investor the opportunity to sell one property and then within a certain time frame, in this case 180 days, find another property from a different seller and invest in that without having to pay capital gains taxes. Let's look and see how it works a little more closely. So the investor wants to sell to buyer and buy from Mr. Seller. In order to qualify for a 1031 exchange, there can be no money that goes from the buyer to the investor. So what the IRS allows is what's called a qualified intermediary. And that needs to be somebody who is arm's length from the transaction, typically a 1031 exchange company or other professionals that can act as a neutral third party. And what happens is, when the investor wants to sell, they give the deed to the qualified intermediary. The qualified intermediary then gives that deed to the buyer, and the buyer gives the cash to them. Now, at this point, the qualified intermediary is holding on to the cash. As the investor is out looking for a new replacement property, if they find one, then what they do is they instruct the intermediary to give the cash to the seller in exchange for the deed, and then the intermediary gives the deed back to the investor. This gives the investor the same effect on the exchange of the property as if they had just swapped deeds, because the investor never takes possession of the cash. In the 1031 exchange process, taking cash is called boot. As long as the investor does not receive any boot or cash or debt relief, then they can avoid the capital gains taxes. There are certain components to this that you need to know, and let's go through them one by one. The first thing to note is what is called the relinquished property. That's the property that the exchanger is exchanging out of, sometimes in the industry referred to as the down leg. When the investor goes to buy a new property, they buy, also RP, what's called the replacement property or the up leg. Finally, the most important thing that the investor has to deal with is the exchange period, the timelines and deadlines that are set in that. The total exchange process can go 180 days. That means that the investor has 6 months from the day that they sell the relinquished property until the day they acquire the replacement property. But even more importantly than that is what's called the identification period. And the identification period is only 45 days. And that means that the investor must identify the potential replacement property, and they can identify up to 3 or maybe even more depending on certain circumstances. But they must identify the replacement property within 45 days of selling the relinquished property, and then they have another 135 days to close for a total of 180 days. It may seem complicated, and in some senses it is. However, it is an extremely valuable tool for the investor to defer their capital gains taxes and keep that money growing in their investments.